Strip, and just you could see everything going. It was awesome.
It's awesome, right?
It's awesome.
There was two good spots. Either one is like at the top of 95, headed out to Boulder. There's a view that like overlooks the whole city, and cars like park along the freeway there. And then, like you said, if you go up there towards like Lone Mountain or like Ann Road,
right
up there in the mountain, you can see the whole city.
Everything. And Vegas does it right.
Yeah,
it felt all over the place. And they were started like 7 o'clock.
It was insane.
It was even dark.
Yeah. I tell people the more hood the city, the more hood the part of Vegas, the longer the fireworks are going to go on for. So in Summerlin, there was a peaceful like 6 to 10. It was like, okay, firework time. On the east side and in Henderson, oh my God.
I'm in North Las Vegas, and I felt like I was in an active war zone.
It was going.
Because all my neighbors had like the most illegal
fireworks.
Yeah, it was intense.
Our dog was just like
in the corner.
Like
some lady said you got a cashier at a place that I won't know just because I won't say her name. A cashier said, "Oh yeah, you just got to feed him a little marijuana brownie, and the dog they're fine. It kills their anxiety."
My in-laws gave their dog
I might
2
need
perks.
to do that next year.
Perks.
It's a German Shepherd, so
gosh.
you know
that's the worst day for a dog.
You got rapper dogs popping perks. No, it felt like the East Side and Henderson were having a fight with each other yesterday of who could just pop off more illegal fireworks back and forth. I swear to God, the East Side was going till like 2 a.m. It was crazy.
Oh my gosh,
it was crazy.
So, and it feels like it's going and going and going.
Yeah,
it's like this is a week where everybody's just kind of like there's no one out there now.
It's the most illegal fireworks of all time. So today we're going to be discussing part 2 of our FHA loan conversation we had last week. If you guys didn't see, last week we did an FHA loan explaining what it was, how to qualify, the new lower rate. So make sure you guys go check that video in the Won't You Be Neighbor podcast playlist. Today, we're discussing how you can refinance that loan. So Bill, this is going to be a star Bill episode, right? Because ultimately, I'm getting people the FHA loan. You're the one actually doing the work, right? This is where I get to be lazy. So when it comes to the FHA loan, we discussed last week, it has mortgage insurance premium for the life of the loan.
Correct.
And the only way to eliminate that mortgage insurance premium is to refinance. So let's start there. What does refinancing actually mean? Explain it to me like I'm 5.
So if you're 5 years old, it's basically you have a loan here and you pay $100 a month.
Okay.
We're going to replace that $100 a month payment, and now you pay $80 a month.
That sounds good.
That's it.
Everyone wants to pay
just
less.
lowering your payment through a refinance by basically getting a lower interest rate.
Is it like most things in the world where I pay a little bit up front to save more money on the back end?
Absolutely. We call it the cost of recoupment.
The cost of recoupment.
And
right?
so basically it's like, how long does it take? How much does it cost to refinance?
Sure.
And how long does it take to pay back the investment in terms of refinancing?
Sure.
And the general rule of thumb is 2 years. So if you make an investment and you pay back your investment within 2 years, it's typically considered a pretty good investment.
Yeah.
It also depends on how long they're going to stay in the home. So if they're going to stay in the home 2 years and it takes 2 years to pay back, no, don't refinance.
It's not worth it.
It's not worth it.
So if you're one of those people who's staying in the home for 2 years to avoid capital gains tax and then you're just going to flip it or something like that, the refinance probably isn't going to be valuable for you, right?
No, it doesn't make any sense. And so we do all the math, and it's just basically about math. How much does it cost to refinance?
Yeah.
How long will it take in months, basically, to pay that back? And what we believe is generally, if it's less than a year, it's like a no-brainer.
Yeah.
It's like you should do it. Because most people buying their house are planning on staying in that house minimum 7 to 10 years.
Sure.
And so normally it's going to make sense for them to refinance over that time period to save long-term on their payment.
And what's the cost? Now, I know it's going to be vary from house to house, loan to loan, but what's the cost of your typical refinance?
Yeah, and so if someone does a loan with us, they purchase with Brandon and I, right?
Sure.
We waive the lender fees, which is about $1,600.
Okay.
And so it keeps the cost of refinancing down. So in general, you're probably looking at about $2,500 to $3,000 in closing costs to refinance.
Wait, you're waiving the lender fees?
I waive the lender fees, which makes it make sense, right? We appreciate the business. We appreciate the opportunity to have worked with you in the first place, and we're going to waive the lender fees.
My clients owe me some big favors. They've been saving $1,600 and they don't even realize it.
Well, but wait a minute. They owe you because you're getting them values $60,000 above the
but now they owe me
price.
even extra, and I like that. So you're saying typically with going through you, it's about $2,500
Yeah.
for a refinance. So the person has to decide if paying $2,500 up front is worth saving them money in the long run, right? Because if they pay $2,500 and they refinance down and they're saving, maybe $100 a month on their mortgage,
Yeah.
right? 2 years, the refinance is paid off.
Yep.
So if they're not going to stay in the house for 2 years, they're not going to make their money back. So putting that money down may not be as valuable.
Right.
Right. The way I always try to, because I'm not an expert on refinancing. I take the messaging you guys give me and what I've learned so far, and what I try to educate people is like, imagine you had a buddy who borrowed $5,000 from you, right? And imagine a week later he paid you back $2,500. You wouldn't stress him paying you back as much because he's already paid you back half pretty quickly, right?
Yep.
And if you take that same situation, you let a guy borrow $5,000 and he's paying you $10 a week, well, you're going to be a bit more stressed about that money because you're getting a very long, it's going to take a long time to get your money back, 100%.
Yep. So, and the nice thing too is when you refinance, when you buy a house, particularly with some of the loans that you're doing right now. So there's a couple things. If you go in with an FHA loan, normally there's a reason why we're FHA, right? Number one, it could be a credit thing where their credit's not super high. And if they went conventional, mortgage insurance would be really high. So the FHA makes more sense. But when they go in to buy, maybe their credit scores in the 680, 700 FICO range. And then a year from now, as rates drop, they understand, they learn the game of credit. They learn how to improve their credit score. So their credit could actually go up to 740,
100%.
to 760. And we help them and say, look, if you get this loan down and you're having a mortgage actually can be really good for a credit
Isn't that
score,
mind blowing for
right?
people, telling them that taking on $400,000 of loans is actually building their credit score? Isn't it like their minds are like, wait, what are you talking about?
I can't think about
I borrowed $20 and they ding me. Now I can borrow $4. Yes, it's crazy. The more money you borrow, the more money they seem to.
Oh my God! And then with the appreciation that we've been seeing and that we are seeing again, and with a guy like you who's negotiating these amazing sale prices, right? I mean, you built in on one $60,000 like immediately.
That's
right?
actually a perfect thing to talk about, right?
Well, it's huge because all of a sudden, a year from now, he's already got almost 10% before he even starts.
Sure.
He put 5% down. You got him 10% because you negotiated such a great sale
Sure,
price.
so they're 15.
So even if the property goes up by 5% in that first year, now he's got 20% equity, right? And he can refinance, remove mortgage insurance, go into a conventional loan, and be done.
Sure. Why
And a lot
is
of times,
that?
the other thing I want to point out too
Yeah.
is with a refinance, most of the time you can roll those closing costs into the loan. So it's not, you're not like out of pocket.
Sure. This is something that blew my mind when I learned it, right? And I love watching people's faces when they hear me say this. You can refinance with your equity. That money doesn't have to come out of your pocket.
No, not at all.
So on this previous example where we saved somebody, they bought a house for $640,000, it appraised for $700,000. When can they turn around and use that $60,000 towards refinancing?
So all loans are no prepayment
Okay.
penalty. So technically you could do it in a month.
Wow.
If you really wanted to.
Wow, I gotta call Paul and be like, hey man, better call Paul,
But,
right?
Yeah, but normally, there's in the mortgage industry, they have what's called it's essentially like VA, for example, you can't refinance until you've made 6 months of payments.
Okay.
To show
So
that.
6 months payment for VA before you
VA.
can refinance.
Yeah.
That's a good little tick.
But a lot of times there's what's called a EPO, early payoff, and most lenders want you to keep that loan for 4 months.
Okay. Why is the 20% number such a rigid and strict number? Why is it that, what is it about 20% that a lender or a bank goes, okay, now that you've put down 20%, we're going to drop your rates and your payments and everything's going to be easy sailing. What is it about 20%?
It's all based on kind of worst case scenarios, right? So if this particular person stops making their payments, right, and the lender has to take that property back, right, and has to sell it, then they're going to sell it probably at a loss, but they have 20% in there to cover the mortgage.
Okay.
So they feel pretty much assured that they're going to get back at least their investment.
Sure.
If somebody has a 20% equity position.
Yeah, I've always seen it as like a skin in the game tax, right?
Yeah, absolutely.
Where the lender's like under 20%, it's people don't want to, it's probably not the good situation to say it, but I got to tell people the truth. Under 20%, when you put 3 to 5% down, it's kind of easy to walk away from the house, right? Like, I know no one wants to walk away from $10,000, $15,000, but it's easier to walk away from $10,000 than $100,000.
Exactly.
You know what I mean? So
exactly.
I think lenders found that out during the crash. Like, hey, I don't care if you have $10,000, $20,000 invested in this house. If you need to get rid of it, you're going to walk away. Whereas someone who's invested $100,000, $120,000 to a house, they might not want to walk away from that. That's a lot of commitment.
Oh, 100%. And if there's 20%, the people that are in the house are probably going to try and sell it to get something out of it, right?
Yeah.
As opposed to 3%. And, you know, for real estate costs, it's at least 6% cost. So, you know, 20% is a pretty reasonable figure that most lenders look at and say that's a good place to be.
Yeah, it's a good standard bearer.
Yep.
It's just a question I know a lot of people are going to ask. Why is it 20%? Why is it 20%, right?
Yeah.
And because there's a large contingency of people who still think you have to put 20% down on a conventional loan. I tell them, hey, why don't you try conventional? And they go, well, I don't have 20% to put down. Dude, you can put down anywhere from 3 to 100% down on conventional. Like, you have a huge range there. It's a controllable loan.
3 to 100%?
3 to 100. Well, three to
That'd be a zero loan.
3 to 99%, right? I've never seen a 99% down, but you get the gist of it.
But people sometimes will buy $1 million home and get a $100,000 mortgage.
Sure.
I mean, it happens, so it just depends. But yeah, that equity position is so key, and you can build that equity through appreciation in the home value. And then you can eliminate mortgage insurance. And my friend over here, Robert Condell, is probably going to get pretty close to being able to remove his FHA mortgage insurance.
Yeah.
His credit score is going up, and when rates drop, he may be able to do that.
Sure. So right now, and this is a big question people are going to have. Right now, you probably wouldn't want to refinance because the rates that you're getting now, like, so if you bought an FHA loan within the past 2 to 3 years, you might be sitting in the 2 to 3s.
Yeah.
I just had a buddy I talked to yesterday where he has a house in Summerlin that they've owned for like 6-7 years. And I was like, okay, let me just, what's your rate sitting at? He's like, we got like a 2.5. Right. So like at this point, he's probably, paying $1,500 for a mortgage. Right.
Right.
And I'm like, he's like, I can't refinance. I can't move out of this thing. I can't do anything. So if you're someone sitting at that range, you probably wouldn't want to refinance.
No,
but
it makes no sense.
if you had an FHA loan closer to like the 5s or 6s, something like that, it might be a good time to refinance, especially since equity has been building so steadily in Las Vegas.
Yeah, it definitely, again, we look at the whole thing. We look at what's your effective rate. What is your rate? What is your face rate on an FHA?
Yeah.
Let's say it's 5%. And then what is the mortgage insurance premium on that? And that could be 0.85% on the older loans, because FHA just made the change and brought it down to 0.55%. So the effective rate of 5% plus 0.85, their effective rate is 5.85%.
Okay.
So if rates did drop down to maybe 5%, 4.75, well, now it might make sense to actually refinance.
Sure. And when they're refinancing, let's say somebody goes from a FHA loan, 3.5% down payment, maybe sitting at like a high 5s, low 6 refinance. When they use that 20% equity and refinance into a conventional 20% down, what are you seeing people's mortgage drop when they hit that 20%? Obviously every house is going to be different, right? That's what we always tell people. But what do you typically see? If I'm a new buyer and I'm coming to you, Bill, and I'm like, Bill, I bought my house 2021, my rate is in the 5s, right? I want to get rid of this PMI. My mortgage is currently about $2,300 a month. I have enough equity to put 20% down. What am I looking at for my mortgage?
Yeah, so eliminating mortgage insurance, depending upon the loan, but let's call it like let's say a $400,000 loan.
Okay.
You're probably going to be paying somewhere in the neighborhood of about $2,500 a year
Okay.
in mortgage insurance, somewhere in there. It can vary a little bit. So call it $200 a month savings just by eliminating mortgage insurance.
Sure. And that's not even factoring in that now the more money you have down, obviously it's going to drop your mortgage, right?
Yeah.
So I want people to know this because I've run the numbers sometimes on live and the numbers, it's drastic. When you play around with the mortgage calculator, right?
Right.
Do you have a mortgage calculator built into BillGaylord.com?
Yes.
Okay.
Yes.
So if you guys go to BillGaylord.com and play around with the mortgage calculator, what I want you guys to do is I want you guys to put in an FHA loan at 3.5% down payment and then see what your mortgage is on a $400,000 house. Then I want you guys to take that same house, put down 20% and see what happens to your mortgage.
It
See
makes
what
a
happens
difference.
to it.
It totally makes a difference. And it's interesting too. If some people have a home right now that they bought about 4 years ago, got a conventional mortgage, not FHA, but a conventional mortgage, and they still have mortgage insurance, call your mortgage servicer to get the mortgage insurance removed.
Yes.
You can do it typically just by getting an appraisal to show that you have 20% equity in there. So,
Yes.
So if you have that, get rid of it now.
That is a great conventional tip. A lot of people don't realize that.
No,
Like
I
if you already
get that
have a
question all the time.
conventional, yeah, if you already have a conventional, so you don't need to quote unquote refinance, all you need is the appraisal.
Yeah.
All you need is the appraisal. The lender will order the appraisal, right? Appraisals nowadays are what, $400 or $500?
A little bit more.
A little bit. Oh,
I know.
boy.
Inflation.
Inflation, yeah. Appraisals and the cost of chips. I went to Costco the other day, and the cost of chips is like $8 for Doritos. I said, this shit was $1.99 a bag. God damn. So appraisals have joined Doritos, and the price has gone up. But
Yeah.
you pay. But honestly, paying for the appraisal is worth it, right?
totally
you pay
worth it.
$500-$600,
Yep.
and now they remove mortgage insurance from your loan. I mean, I promise you, you're going to save more than $500 and $600 when you do that. Right?
Yeah, and I've seen too where it depends on the servicer, meaning who do you make your mortgage payment to? Some people will do basically an in-house appraisal. They'll call it an AVM, automated valuation model, and then they'll figure out that they have that money, and then they may not need the appraisal. So it just depends on the mortgage servicer.
Man, look at that. Look at that. I think refinancing and FHA loans is such a big topic, and it's such a topic on everybody's minds. When I teach my class, this is one of the big things that always comes up. People are concerned about refinancing, HELOCs, and FHA loans. So I think we were able to cover a lot of that in one go.
Can I give my last words here?
Interject. Let's go.
Basically, if you're looking to buy now, I think it's awesome to buy right now because there's less buyers in the market. You're going to pay a premium on your interest rate. You may go into an FHA mortgage that has mortgage insurance premium, but long term, what you're going to be able to do is reduce that, eliminate mortgage insurance. You're going to probably increase your credit scores and get the best rate out there. So for the long term, you're going to do really, really well.
100%. It's taking a hit on in this life. I don't care if it's real estate, business, stock market, whatever. If you want to wait for Amazon to blow up and then buy when it's safe, go ahead. But you're going to pay more upfront for smaller gains.
Yes.
If you want to take a risk and buy Amazon when it's just starting out, you're going to take a risk up front, but the gains on the back end are huge. And I think real estate is similar in that, right now, if you're buying into higher interest rates and higher mortgages. That's the front end cost. On the back end, there's more equity to be made. There's less competition from other buyers. And as we just taught you guys, you can just refinance the loan. You could just refinance the loan. You're sitting in a loan for 1 to 2 years that may not be perfect, but guess what? You got your house way cheaper than the next guy.
Yeah, it's all risk tolerance. It's calculated risk. And if you calculate what your risk is and you can live with it, I mean, go for it.
100%. Bill, thank you as always. How do we reach you? People who are watching the video who may want to fill out the mortgage calculator, may want to reach you directly. How do they do so?
BillGaylord.com and my phone number 858-776-6830.
Boom. We'll make sure Austin gets that on the screen. Very easy. As always, I'm Brandon from Vegas. If you want to reach me, it's easy. Go to your Google, type in Brandon from
He's
Vegas.
a celebrity.
Pick your platform of how you want to reach me, and let's get after it. As always, guys, it's a pleasure to have you.